Hi, and welcome to our webinar, Is Pandemic Mortgage Relief Helping Homeowners? I'm Andy Winkler, the Director of BPC's Housing and Infrastructure Project. We have a really terrific lineup of speakers today to discuss the sort of myriad programs and protections assisting homeowners with COVID-related financial hardships. I'm going to forego pretty long introductions since we have a packed agenda today. And first up, we have John Pendleton and Matt Rabe joining us from the U.S. Government Accountability Office, or GAO, which is Congress's sort of watchdog agency. They both work in the Financial Markets and Community Investment Division. They're going to run through a brief presentation sharing some facts and findings from GAO's very timely report on mortgage forbearance, other federal protections to help struggling borrowers, and the impact that those have had. I just want to say, if you're watching live on YouTube or Facebook, please submit any questions that you have for Matt and John in the live chat. We'll turn to those right after their presentation. You can also tweet your questions at BPC_bipartisan or using hashtag BPC Live. Matt and John, thank you so much for being here today. I'll turn it over to you.
Thank you so much for inviting us. We really appreciate the opportunity to tell folks about our work. The teams work really hard on them, and the fellow that's going to present to you the findings has spent the better part of the last at least several months working on the data he's going to show today, and we welcome the opportunity to tell everyone about it. In case you don't know what GAO is, the Government Accountability Office, we're part of the legislative branch, and it's in fact our centennial year. We've been around 100 years. We're created at the same time as the Bureau of Budget, now Office of Management and Budget. But when the CARES Act passed, the Congress put us in our traditional oversight role and gave us a very broad mandate to report periodically every couple of months, comprehensively on efforts across the government, as well as standalone reports on topics of interest. And earlier this year, we did a report that was also timely at the time on evictions and evictions and rental assistance efforts. And that report also got a lot of traction. And this report just came out a few weeks ago as the moratoriums are ending, and we're trying to sort out kind of where we are and where we go from here. This report on forbearance and foreclosure is information packed, and Matt did a lot of analysis work to kind of cut through and I think tease out some of the key things that we need to know. And if you're familiar with GAO, you're going to know that what I'm about to say is very unusual coming from a GAOer, and that there's some good news here. Okay, the efforts really did literally help keep millions of people in their homes during the pandemic. So with that intro, I'm going to turn it over to Matt and let him tell you the details. Matt?
Hi, great. Thanks, John, and thanks, Andy. Glad to be here. As I mentioned, my name is Matt Rabe. I'm an analyst with GAO, and I'm just going to go over a couple of key findings from our recently issued report titled COVID-19 Housing Protections, Mortgage Forbearance, and Other Federal Efforts Have Reduced Default and Foreclosure Risks. So our report largely focused on two tools that the federal government used to protect homeowners during the pandemic, both through legislation and additional administrative action taken by federal agencies, including CFPB, FHFA, FHA, VA, and USDA, and the government-sponsored enterprises Fannie Mae and Freddie Mac. So first, we're going to look at mortgage forbearance, which allowed mortgage borrowers to temporarily pause their payments. And second, we'll discuss the effects of the foreclosure moratoriums, which prohibited servicers from initiating new foreclosures. So starting with forbearance, we wanted to assess the extent to which borrowers took up forbearance and identify any differences across federal agencies or lending channels. Just want to add a quick note here that our period of analysis ended in February of this year, which was the latest available data at the time of our reporting. So we found that forbearance rates were very low leading into the pandemic, but quickly rose beginning in March and April 2020 after expanded forbearance options were rolled out. The overall rates peaked in May with about 7% of all borrowers in an active forbearance plan. And you can also see there's a big difference between borrowers with loans backed by FHA and USDA's Rural Housing Service which are generally provided for first-time home buyers, minorities, and those with lower moderate incomes when you compare those to conventional loans. So breaking it down further by borrower characteristics, we found that Black and Hispanic borrowers took up forbearance at roughly twice the rate of white borrowers, and also represented a disproportionate share of borrowers in forbearance. And research from GAO and others has found that Black and Hispanic households have generally been more economically affected by the pandemic, which is further supported by the use of forbearance. And we also identified similar patterns across first-time home buyers and those living in lower moderate income census tracts. We also analyzed incomes and other financial characteristics of borrowers in forbearance and found that borrowers in forbearance for longer periods tend to have lower incomes and higher risk loan characteristics. So the 4 panels in this figure show medians of borrower income, credit score, combined loan to value ratio, and debt to income ratio. And the x-axis is total months spent in forbearance. So we found, just to explain the figure a little bit, borrowers who never entered forbearance are represented by the dots all the way on the left of each panel, and they tended to have the strongest incomes and other financial characteristics. The dots on the far right show borrowers who are in forbearance for a full year. So generally speaking, borrowers remaining in forbearance for longer periods tended to have lower incomes and credit scores, less equity in their homes, and more debt. We also found that delinquency and missed payments have grown among borrowers in forbearance. For example, we estimated that on average, borrowers in forbearance as of February had missed about 8 payments and owed about $8,300 in principal and interest. So the next question is, how will all of that be repaid? And this is where federal agencies and the enterprises took action to accommodate borrowers in forbearance plans. For example, they extended options to enter forbearance through September 2021 and have allowed borrowers to remain in forbearance for up to 18 months. They also streamlined existing and introduced new loss mitigation options, such as payment deferrals, loan modifications, and refinancing opportunities. And this figure here shows data from the Mortgage Bankers Association that break down the status of borrowers who have exited forbearance. And we can see that about 28% of borrowers have remained current during their forbearance term, and another nearly 40% entered into either a deferral or partial claim loss mitigation plan or reinstated their loan with a lump sum repayment. However, nearly 14% had exited with no loss mitigation plan in place, which may leave them more vulnerable to foreclosure. And according to the latest MBA survey, these proportions have largely remained similar through mid-July. And another group we looked at was borrowers who fell 2 or more payments behind, but for whatever reason did not opt into a forbearance plan. So the good news here is that relatively few, specifically less than 1% of borrowers fell into this category. And you can kind of see an inverse pattern when comparing this figure to forbearance uptake. We looked into some reasons why this might be the case, and we identified 3 commonly identified causes, which were especially true earlier on in the pandemic. First, we heard that borrowers may have simply lacked awareness of forbearance options. Second, they may have been deterred from using forbearance after being given misinformation or misunderstood the terms. And a third reason we heard that may still be a lingering issue was just hesitance to contact their servicer due to historical distrust, which could be partly due to some of the fallout from the last housing crisis. So to get the information out about forbearance, in addition to several online resources, federal agencies and the enterprises took steps to directly reach out to delinquent borrowers through mailings, phone calls, and additional training for housing counselors, just to cite a few examples. CFPB also amended regulations to require servicers to discuss forbearance options with delinquent borrowers. While there are relatively few borrowers in this situation, the bad news is that these borrowers tended to have the lowest credit scores among other financial characteristics. For example, this figure shows distributions of credit scores by loan status as of February of this year. So the box all the way on the left are borrowers who were current and not in forbearance, who tended to have the highest credit scores. And the middle box is borrowers who are in forbearance. The box all the way on the right are borrowers who are delinquent and not in forbearance, who tended to have the lowest credit scores. For example, the median credit score among these borrowers was 540, which is considered subprime. So some of the borrowers who may be in the greatest need of assistance may not be getting it, and it could additionally point to some financial literacy challenges or other issues. And this could be problematic because these borrowers don't have the same protections as those who are in active forbearance plans. So this is partly where the second tool, which is the foreclosure moratoriums, comes into play. So the CARES Act passed back in March 2020, created a foreclosure moratorium from March through July 2020 for federally backed loans and properties. And so federal housing agencies and enterprises separately initiated and extended their own moratoriums on foreclosure, which expire at the end of this month. And I believe the panelists are going to get into that a little bit more coming up. We can see evidence in the foreclosure moratoriums in the data as foreclosure starts have declined by 85% year over year during the pandemic. And additionally, CFPB just recently amended regulations to help servicers streamline the process of processing loss mitigation options and limit foreclosures. And another factor that may help mitigate foreclosure risks is the rapid house price appreciation we've been seeing during the pandemic. So to get at this, we estimated mark-to-market borrower equity as of the fourth quarter of 2020, and we found a very small percentage of borrowers were underwater or had no or negative equity in their homes. In fact, only about 2% of borrowers who are delinquent or in forbearance as of February were underwater, meaning the vast majority could, in a worst case scenario, still sell their homes and avoid foreclosure. And this lies in stark contrast to the last housing and foreclosure crisis. So we looked at data from 2011 and found that 17% of all borrowers and 44% of those who were behind on payments were underwater at that time. And with that, I'll pass it back to Andy to see if we have any questions.
Thank you so much for that. A ton of great information. It's a really timely report for this conversation. So I want to encourage anybody who has questions viewing to please submit them in the live chat. I just want to see Matt and John, if you could kind of preview what's next for GAO. How will you continue to monitor all of the federal government's various sort of policies, procedures, moratoriums, et cetera, that have been put into place? Can you give any preview of what's next for GAO on this topic?
Well, the first thing we did, Andy, was give Matt and his teammates a little bit of a break. I insisted they take vacation because it's been a busy year for them. But we are rolling almost directly into some work looking at how the emergency rental assistance funds are being administered, kind of under that broader CARES Act mandate. We have a report coming out later this year looking at the vulnerabilities at the housing finance system, what the pandemic revealed about the vulnerabilities and how what lessons maybe we should learn from that. And then we'll just be monitoring all of these efforts as part of the broader work. And like I mentioned, GAO is reporting periodically. So if we see something going sideways, I mean, so far it's been okay, right? But you can look at that foreclosure drop is, 85% drop is great, but it also could, some of it could be a tsunami washing the shore, depending on what happens, because there's always some foreclosures. So we're watching all of this, but we have some specific work ongoing as well.
Great. Thank you, John. So I'm not seeing any audience questions. We've gone ahead and shared GAO's report in the chat. So please be sure to check it out if you have not yet. The link is there. Thank you, John and Matt, for popping on and giving us a little level setting for the conversation we're turning up to next.
Thank you, Andy. We look forward to the conversation.
Thank you. So I'm going to quickly introduce Sarah Singha. She is from the Mortgage Bankers Association. She has very generously agreed to moderate our next conversation with a host of really phenomenal housing experts. So Sarah, I will turn it over to you and just say thank you so much for doing this.
Thank you, Andy. Great to be here. I'm going to introduce our incredible panel, and in order to save time, I'll just I'll note their current positions, but you can find their biographies in the chat function, I believe, or the link to the YouTube video. But today we have Meg Burns, Executive Vice President at the Housing Policy Council, Crystal Cornegay, Executive Director at Mass Housing, Dana Wade, she's currently Chief Production Officer at Walker and Dunlap, but formerly she was HUD Assistant Secretary for Housing and the Federal Housing Commissioner. And Tanya Tyler, Vice President at National Initiatives at NeighborWorks America. So fantastic panel. So glad that you all could be here with us today. Before we get started, let me quickly remind our viewers that they can continue to post questions for our panelists at any time through the chat. If you're watching live on YouTube or on Twitter, you can post questions using hashtag BPC Live. And we'll be monitoring those questions and trying to get them in as we can to get our panelists to answer them. So turning to our first big question, I guess, to throw out to the panelists, you know, Matt and John did an amazing job. That was an incredible report, very timely and very relevant at this stage. Clearly, these foreclosure and forbearance protections that have been rolled out by the federal government and by the federal housing agencies, they've worked. They've reduced defaults or minimized them and foreclosure risks. So clearly they have been successful, but I want all the panelists to sort of take it just a step back and look at the federal efforts in terms of what kind of lessons learned do you take away from the agency responses and how these programs were rolled out? So I guess I'll start, Dana. Can I start with you?
Absolutely, and thank you so much for having me here today, BPC, and honestly to the folks at BPC, thank you for all of your work on the important issues. I am absolutely delighted that I sit on a panel here, a council of members to address affordable housing issues and racial equity issues in housing. So it's great to be here today. It's very hard to really follow the experts at GAO though, but I'm delighted that they could come as well. I want to say a couple of things. And I think, you know, again, following the GAO data, first of all, I'm extremely proud of the work that we did at FHA and at HUD to help, you know, basically as many homeowners and renters as we could. And I think we rolled out a lot of tools that have been very successful in reaching millions of people. So, I mean, that's a great thing. That does not mean that there isn't more work to be done. There is. And, you know, I think one of the lessons that we really learned, we went through 2017, and Meg probably remembers this well. We had 3 hurricanes in a row. We had Harvey, we had Irma, we had Maria that impacted a broad swath of the country. So we had to act then and act fast and put in place tools to be responsive to borrowers and renters in need. And, you know, one of the things that I think stands out is the partial payment of claim option for homeowners. Now, I don't mean to get too in the weeds, but this is basically a second lien. You know, you kind of wonder, okay, you're a borrower, you're in forbearance, you can't make your payments, and it is as a result of a natural disaster or another disaster, such as a pandemic. What do? Well, you have forbearance, you know, the government is going to allow you a little bit of time to catch up. But what do you do with the missed payments? That was always the question. And I think that option has been very successful in kind of taking those missed payments, tacking them to the end of the loan, so you're not just sort of all of a sudden hit with that liability. And, you know, I think that has been successful in helping folks. I think just kind of speaking from FHA's perspective as former commissioner, there was still about 10% or so of the portfolio that didn't qualify, that were in need, that didn't qualify for this option. So I think it's that 10%, you know, that may be a borrower that had issues before the pandemic, and the pandemic hit and it just made things a whole lot worse for them. There really is a subset that is still in need. And I think, you know, it's important to focus on those folks as well. There are more borrowers that have conventional loans, Fannie or Freddie, that are able to resume payments than there are FHA. There are certainly more minority and low income borrowers at FHA that need assistance. And, again, I think that's really who should be targeted as we have the discussion about what's working and what is not.
Thank you. Other panelists? Meg, do you want to weigh in?
Sure.
Tanya,
Yeah.
Crystal?
Yeah, I'd love to weigh in. Do you want to go first, Crystal, or you want me to go? Okay. All right. Well, so Dana actually pointed out something that was really important for all of us at the very outset of this pandemic. We had the disaster programs to turn to as a model. And I would say that one of the big lessons learned and one of the big positives of this pandemic in terms of engaging with the government community, all of the various government agencies, when I reference community, was that we had a really positive, proactive dialogue with agencies who had programs on the shelf that could be deployed fairly quickly. There was momentarily in March of 2020, a period where the industry was saying, maybe you could all have aligned programs, maybe you could all offer the same program, but it was immediately apparent that that would be very difficult to do, particularly in an emergency situation. So instead, the communications pivoted to, as long as there are similar outcomes for customers that will achieve the same kind of result in terms of their payment. So when Dana was referencing the FHA partial claim program where the borrower can roll up all the missed payments and put them to the end of the mortgage, the GSEs have a similar type of program, not precisely the same, but similar. The USDA has a similar type of program that is probably most consistent with FHA's, and the VA just rolled out a similar program. And that is a great solution for borrowers who can resume the payments at the level that they were at previously. But there are also borrowers who need a payment reduction. Maybe their income has actually changed as a result of the economic conditions of the pandemic, and those borrowers need a loan modification. So every one of these agencies also had those types of programs on their books and on the shelf, and could pull those out and reformulate them as necessary for this pandemic, so that those kinds of programs are available across the board. So I would say one of the big lessons learned, one of the benefits of the communications during this pandemic was that the government and the industry and the consumer advocacy community, frankly, all worked really collaboratively to make sure that what we were seeing and what we were trying to address, whether, depending on what seat you were sitting in, we were all in communication with one another constantly and trying to make sure that the programs worked well. So I would say that that was a really positive lesson learned and positive perspective from this pandemic.
Crystal?
And I was going to say, I just want to talk about another resource that we haven't talked about, and that's the housing counselors. Big lesson learned for NeighborWorks is our housing counseling agencies are really there in the communities, embedded in the communities. They understand where all of the resources are. And I think for us and for the country, understanding that the housing counselors are a big resource, they make a huge impact, and they can really get into those communities that are harder to serve.
Great. Crystal, did you want to add anything?
No, I didn't want to add anything. I do want to, I think the outcomes were perfect given the circumstances that we had. And I'm looking forward to talking about how we move out of this. Because while the partial claim and tacking on the missed payments to the end of the mortgage is a great way to keep people housed while we're dealing with the emergency. As the data said, most folks in forbearance and who are using those are people who are low income and minorities. And so this, in some ways, while it kept them in their house, is eroding their equity. And looking forward to talking about how we might use HFA to help deal with that as a solution.
Actually, that's a really great sort of segue. I wanted to talk a little bit about the borrowers who most vulnerable at this stage. So up until now, we've seen a lot of success getting borrowers into forbearance quickly, getting many borrowers out of forbearance quite quickly. And up until this point, the borrowers exiting forbearance, a very high number of those were able to continue making their payments while they were in forbearance, or were able to either reinstate entirely afterwards, or able to go into one of these deferred programs where they can take the forborne amount, put it on the end of their loan, but then they're able to resume making their previous regular monthly payments. So now the population of borrowers that are still in forbearance, and I think based on MBA's latest survey, excuse me, they're about 3.5% of borrowers across the servicing portfolio that still remain in forbearance. And these borrowers, now we're seeing that the borrowers that remain in forbearance typically are going to have up to 12 or maybe even sometimes up to 18 months of forbearance that they have got to deal with. And as the GAO report indicated, we know that these borrowers there's more of the government agency loans that are using the forbearance, typically lower incomes, typically minority communities of color that have been hit very hard by the pandemic. So I wanted to talk about how we move forward. We've got a more challenging, the borrowers that are still in forbearance really have a more challenging situation to get out of. Just this past Friday, I think the agencies announced a variety of new programs to deal with borrowers that are exiting forbearance now or will be over the next coming months with these significant forbearance amounts to repay. So Meg, can I throw it to you to talk about some of the new program announcements, and then I'd like us to then think about other ways such as the housing assistance funds that may be available.
Sure, absolutely, happy to do it. So let me actually ground it first with the number that we look at MBA data, we look at Black Knight data. Black Knight's actually a member of HPC, so we look at their data regularly as well. And it's about 750,000 borrowers who are in FHA, VA, and rural development loans who are in forbearance and who are in need of these programmatic solutions. I would say what's interesting about the announcements on Friday is that, to me, I would not say that these are new programs per se. I would say that these are reformulations of existing programs. And in particular, VA and USDA did a tremendous job of thinking about ways to enhance the way that their programs can be used either in conjunction with one another or to be used in a more expansive way so that borrowers can get a more substantial payment reduction. All three of the agencies announced that they were asking servicers to reduce the borrower's monthly payments by a certain amount in the range of 20 to 25% of the principal and interest. So all three agencies had that sort of framework that they were operating under, that borrowers, these particular borrowers who may be in a more difficult situation, would be eligible for this kind of payment reduction. The USDA and the VA both said, we have programs that now should be used in combination with one another to try to drive that payment reduction. Interestingly enough, FHA went in the opposite direction, and FHA actually said, we expect you to use the existing program lineup, but we are going to put some new restrictions on how those programs can be used. And so an example is the partial claim, where you roll up all of those missed payments into this second lien that is a non-interest bearing second lien that sits behind the first, due on sale of the property, due on payoff of the loan. That to date has been available to cover up to 30% of the unpaid principal balance. FHA said we're now going to restrict that to 25% instead of 30%. They also said that for the modifications, they're going to cap the interest rate that can be used in those modifications. So those are two changes to the programs that make the solutions a little bit different from what they were previously, and that will make it a little bit more difficult for servicers to immediately offer all of these programs. I think that is one of the primary concerns that we have, that we are seeing, you know, July, there's a few more borrowers who are expiring, where their forbearance is expiring, August more, September more, October more. I think October might be one of the peak months. We actually have one servicer who has said they have more borrowers with forbearance plans expiring in October than they would in any normal given year. So with these program changes, all of the servicers are called upon to retool the offerings available to customers. And of course, that changes how they communicate with the customers as well. So that's a bit of a concern. We appreciate that the agencies, to a large extent, try to stick within the existing programs, but even these small tweaks to programs, and some of them larger tweaks to programs, are definitely make it a little bit more challenging right when we're in the high volume months, high volume forbearance expirations, that is, you know, coming up. So that is a bit of a concern. I would say, however, that the servicers, because they've been so conscientious through this entire process, and they have been aware that there could possibly be a payment reduction requirement coming, they've been very carefully tracking and monitoring and thinking about what they need to do. And there are a couple of months when they will be in this process of implementing and executing against these new programs.
I have to say that, you know, I agree. And honestly, I know there was a slate of changes that you just went over at FHA. I'm not as familiar with those. However, I think getting as much uniformity across government agencies, including the GSEs, is always the most ideal thing, because honestly, when you are a borrower, you don't really know who backs your loan. You don't know who guarantees it. You don't know if it's Fannie or Freddie. You know who your servicer is usually, although sometimes that can change too, as we know. But it is a confusing time. And I want to go back to something that Matt pointed out through the work that he and John did at GAO. And that is, you know, what were the reasons that borrowers were not resuming payments? Well, there are a lot of reasons, but some of them were that they lacked the awareness, they lacked the information, they were probably scared. You know, they were probably, when you are in need, you don't always think, I'm going to reach out to my mortgage servicer, who is basically there to kind of collect the debt. Fine, that's the job they have, but they don't think of them as someone who can help them out of a time where they are in need. And I think I want to go back to Tanya's point too, just engaging the housing counselors and the network that we have. And we worked really, really hard at HUD on housing counseling certifications and making sure that we could extend and expand that network, as well as covering renters, by the way, which I think is a really important role for housing counselors. But that there is a trusted, independent party that can educate them, give them the information they need so that they can work with their servicers. You know, again, the country has housing counselors in urban areas, rural areas, suburban areas. They're everywhere and they're there. And the government has done a good job at expanding this network, at funding it, giving it the resources that it needs. So, I mean, I just can't emphasize enough, you know, if we really kind of are looking at the root of the problem and trying to help borrowers and renters, how important it is, reach out to a housing counselor. You know, they're there. There are options for borrowers and for renters. And, you know, I wrote an op-ed kind of towards the end of my tenure, and I've heard the same thing echoed by Secretary Fudge at HUD. There are a lot of tools available for homeowners and renters. And, you know, again, just getting the information out there, getting a source they can trust, I think is very important.
Absolutely agree. And speaking of additional resources for homeowners that may be coming available, we have the Homeowner Assistance Fund program that was It was set up in the America Rescue Plan, and it provides funding for states to set up mortgage relief and other types of assistance. I know the programs are still being developed by the states, but maybe Dana or Crystal, can you speak? Crystal, you're the head of the mass housing. Can you speak a little bit about what you expect the housing assistance funds to be used for in your state, and how that might work?
Sure. I want to say that the programs, the solutions to date have been great because they have kept people housed and they didn't really spend any money. And so when you have money, the question is, what is the policies? What are you trying to solve with the money? Because we know we can have solutions related to mortgages that will, have the mortgage outstanding balance tacked onto the end, that can help restructure the debt and the payments, right? And so if you have money, what are you trying to solve for now? And that was a lot of what we thought about on a state level, right? And so it's like thinking and Treasury required all the states to do that in terms of having a homeowner assistance fund plan. It's like, look at the data, who needs the help, where are they, what are the geographies, and then how are you going to get the help to them? And so we spent a lot of time looking at the data and thinking about that, and really thought that the highest and best use, initially anyway, was to focus on mortgage reinstatements, right? And just to find people where they're at, and figure out, what is their economic situation and get them reinstated. Because even if you are having challenges maintaining that mortgage past the reinstatement, it's a whole different conversation once you're reinstated, right? And then servicers can be more open, investors can be more open to the idea of restructuring loans and what that might look like. And so we're definitely trying to focus on that in the pilot. But then some of this is, as Dana was describing, you kind of don't know exactly, you only know about what you know about, right? About the people who showed up. And you can extrapolate data from the folks who showed up, but we know that there are folks who haven't shown up, or they haven't shown up because they went without other things so that they can pay their mortgage, right? And so they're in a different kind of financial position. We know that the supports that came from the federal government for households in terms of income supports, additional payments through unemployment, the sort of one time, or I think it was 2 times, payments to families. We know that folks use all of the resources they had to the best of their ability to not lose their housing, whether it's rental or homeownership. And so we're also really trying to partner with our local housing counseling agencies to make sure that we're doing outreach, that people have a place to go, right? Because it is a very sensitive situation too. It's not just that people don't know, but even when they do know, they may be embarrassed and they don't know, right? Like they don't want to say to somebody that they can't make their payment or that they're having trouble. And so we know that we have to have what we describe as a retail solution, so that folks have a person to talk to, not just a number to call, but a person to talk to, and have options around that. So in a lot of states, that's really what I would say mass housing and our sister HFAs are really thinking about. How do we deploy the money in a way that can keep people housed, but also take advantage of these other kind of non-monetary solutions to people's issues, so that we can help as many people as possible without necessarily saying everybody's going to get some of what comes through the homeowner assistance fund.
Thanks.
And I think that's right. And I think just to add to that point, you know, I think a lot of us have been through multiple disasters, nothing like a 100-year pandemic. And I mean, this really, you know, was a curveball and a very, very difficult situation for the country as a whole. And you are, you know, when you're faced with these unpredictable, widespread situations, you always have a choice between, am I going to get the money out fast? Am I going to get it out in a targeted way? If I'm not targeted, then I run into other issues, right? And I think, you know, to Crystal's point, yes, there was a lot of direct assistance available to individuals and families. And that was the right thing to do. We did go through a time period where we just had to get the money out. And people just needed help. And, you know, we didn't know what kind of situation. We didn't know how long the pandemic would go on. It's still going on, by the way. We still have curveballs being thrown at us. But people just needed help. And now we're kind of in a situation where people need more targeted help. You know, I'll use rental assistance as an example. You know, according to the data, according to census data, there are still over 1 million renters out there who are facing eviction. And yet on the other side, we have $46 billion that has been appropriated by Congress to go to rental assistance. And you know, I don't think there is a perfect solution here, because the right thing to do was to give that money to the states. If you're not going to see a homogenous situation, it is definitely the best thing to do to give the money to the states, let them handle the program versus creating a new federal bureaucracy. I think no one questions that. But one thing that I think folks ran into is that there are some state agencies that are better at handling this than others, that are more sophisticated, that already have rental assistance programs set up, and some that don't. And so, you know, that's why you're seeing a little bit of a lag. You know, I do believe the numbers that I've seen recently are very promising. And I do believe that the programs are being put in place. I know there's technical assistance available from HUD. You know, I'll say from HUD's perspective, though, most of the landlords are private owners, and HUD is great. Actually, HUD did a fantastic job getting money out to the affordable landlords and to folks who were in kind of more affordable Section 8 programs, for example. They have a whole network through housing assistance, the HAP contracts, housing assistance contracts, that they're able to reach them directly. But you're talking about a whole universe of renters and private landlords that are not hooked into existing HUD programs. So, you know, everyone knew that was a challenge. It's still the right thing to target. It's still the right thing to let states kind of create their own programs. I do believe what I've seen lately is more promising, in that, you know, I think they're finally able to move the ball forward on getting this money out and getting it to people who need it. But again, I just want to say there's no perfect solution. You're always making that calculus. Do I get money out fast, or, you know, how do I balance that with getting it to the people who truly need it?
Sarah, can I mention something on the Homeowner Assistance Fund that Dana made me think of in terms of the rental program? So the Homeowner Assistance Fund program is only $10 billion, but there's still that question about trying to get the money out as quickly as possible. And certainly the states have been busy developing their plans. I know a number of them have completed their plans, and they're you know, working with Treasury to get those submitted, et cetera. But one of the interesting things about the timing issue in the homeowner space is that in some respects, when the money goes out, it's critically important that it get out as quickly as possible to help those in need, but it doesn't have to align perfectly with the time frame of the loss mitigation solution, of the decisioning around how to help the customer per se. And there have been some conversations about that, where people think that at that juncture, that is when the dollars will have the most impact. But in fact, it actually kind of complicates the resolution of the forbearance in some ways if all these things are happening at the same time. So the extent to which the dollars can begin to flow out and be used to satisfy those missed payments and just reinstate the loan, just as Crystal mentioned, would be ideal. And I know that a number of the states, just as she said, are really focused on that and trying to make that happen. We at the Housing Policy Council were big advocates for these dollars because we knew that the borrowers who were left had the most extended periods of forbearance. Those who have 18 months, for example, are the ones who really these dollars can benefit the most, preserving their equity, also, as Crystal had mentioned previously, reinstating the loan. So the extent to which the dollars can flow out before there are loss mitigation discussions underway with the servicer, fantastic. Get those loans reinstated, get that money into the pockets of those most in need. But even if it comes after the fact, and a borrower, for example, has a partial claim, has this second lien that represents the compilation of those missed payments, if these dollars can be used to pay off that second lien, and again, give them back some equity, that's great too. And so again, we're advocates for these dollars going to those who are most in need for just these reasons. These are higher risk borrowers who can really benefit from these dollars, but paying off those outstanding arrearages at whatever stage they're at in trying to resolve the forbearance period. So I just want to mention that because we really are big advocates for the Homeowner Assistance Fund program.
Yeah,
And
I wanted to say one more thing that Dana made me think of. It's hard to move $46 billion. It just is difficult. And that's $46 billion for that. It's $10 billion for this. It's the $300+ billion of ARPA at the state and local money. That's a lot of money. And yes, we need the money, and we're very, very appreciative of the thoughtfulness that went into designing this. But if you want to move that money in a way that is judicious and efficient, and sort of tries to take care of the idea of people not wanting to be cheating the system, so to speak, then you got to build systems around that, and that takes time. And so the moratoria, both on the homeownership side, foreclosure and eviction moratoria, is giving states and localities time to develop the systems that they need in order to move this money quickly. And as Dana was describing, a lot of the slowness about this had to do with just that, right? What is the efficient system in order to do that? The other thing about that is everybody's situation is not the same, right? And so some people, especially what we're learning through the home ownership and looking at data, is some people have had problems a long time before the pandemic, and really trying to figure out, okay, what are we doing about that, right? And so, and really trying to make sure that this becomes a solution, not just that it's only pandemic related, but if you're gonna build an infrastructure that includes counseling agencies and municipalities and servicers, and let's build a system and try to solve as many challenges for folks so that we can, recover, build back better, or right, so that we're not dealing with these kind of lingering kind of problems, in 4 and 5 years.
Great points. I did want to ask Tanya, NeighborWorks got a chunk of money from the American Rescue Plan, correct, to put towards housing counseling. We've mentioned the role several times during our conversation about housing counseling and its role in working with borrowers, but can you talk a little bit about what your plans are and how you're going to implement and disperse the money that goes to the housing counselors?
Absolutely, and thank you for that, Sarah. NeighborWorks, first of all, we're just honored to have the opportunity to administer American Rescue funds and the opportunity to continue our work with housing counselors. NeighborWorks American Rescue Plan, which we're calling the Housing Stability Counseling Program, will provide those resources to housing counseling agencies so that they can support the people who are facing housing instability all across the country. And our application closed at the end of June. And we know that the need for these resources is high just based on the applications that are currently under review. We received application requests for over 338 million, which is very oversubscribed for the amount of funds that we have. But what was interesting and what we've been talking about on how this pandemic is different than the foreclosure crisis that we had before is that this funding provides resources to assist both homeowners and renters. So we were excited to see as the applications came in that it was almost a split down the middle of the counseling agencies, that they were going to serve both those homeowners facing foreclosure and the renters who might be facing eviction. So that's interesting to see. And in all of the applications, it looks like we're going to serve all 50 states, including Puerto Rico. One of the things that NeighborWorks did, we had some big lessons learned from the NFMC, or the National Foreclosure Mitigation Counseling Program that we operated. And so we used that to help us design this program. We utilized CDC's Social Vulnerability Index to help us determine which were the areas of greatest need. And the majority of the applicants that have applied for this program have proposed to serve the majority of their clients in those areas, which we're not surprised about, but it's good to see. We see this program as providing counseling services, particularly in those areas that I discussed earlier that are more difficult to reach, our rural areas, our native populations, serving those with limited English-speaking residents. We've built a really strong foundation with our industry partners that includes HUD's Office of Housing Counseling, Consumer Finance Protection Bureau, and Treasury. One of the lessons that we learned from the last crisis was really surrounding yourself with these agencies who have the same type of grantees that you have, so that the agencies that participate have that experience. They see that collaboration. So we've discussed having a lot of joint webinars and information sharing throughout. And I just wanted to take a moment to look back at the impact of housing counselors and some of the things that we found in NFMC, that those clients who have received housing counseling are nearly 3 times more likely to receive loan modifications, 70% more likely to remain current on their mortgages after receiving that modification. The average payment reductions in the last program was $4,980 per year, and cumulative received annual savings of $518 million. And that just goes to show you the true impact of housing counseling agencies and how they're embedded in their community and provide those resources.
That's very impressive. Thank you, Tanya. I know we're getting a little short on time here. We do have a couple of questions from our audience. The first comes from Joshua Stewart. He mentions that the highest percent of loans that are behind in payments but not in a forbearance or USDA loans. And they also have the largest percentage of underwater borrowers. With the moratoriums ending, actually at the end of this month, the federal foreclosure moratorium is going to be lifted. How do we prevent disproportionate impact in rural?
That's a great question, Joshua. And I will say, I'm glad you brought it up. This is one of the things that we were talking about in terms of when you think about targeting. Meg was talking about not just folks in forbearance, but delinquent, right? And so what does that mean? But again, that is much more, to Tanya's point, a bit of a retail solution, right? And so why are you delinquent? What's going on? Can you make your payments? Once we reinstate you, can you make your payments? And that is a high touch thing. And that's what people really need in rural. I don't want to say what people really need, but I will say in rural areas, we have to be conscious of the fact that the way to reach people and address their needs are different in rural communities. Mm-hmm. One of the things we're doing in Massachusetts is we're going to pilot our program there in a rural community and, a rural part of our state, to make sure that we get there first, right? And we're starting to see certain things in those portfolios. So I would say to you, Joshua, I hope you're in a position to continue to advocate with your state to address the needs of rural folk.
And we also have another question, this one from Scott Kennedy. He asked, how do the panelists view progress in integrating the Homeowner Assistance Fund with the policy tools that the agencies have deployed to date?
So let me jump on this a little bit, Sarah. At the Housing Policy Council, we actually have been doing weekly calls with all of the state program administrators and the servicers, as well as some of the government agencies, specifically so that we can make sure that everyone is communicating as the states are developing their programs. And we were focused on 3 elements of the program development: the programs themselves, what is the design of the programs, and how do those programs sort of interact with the government agency programs, which of course is the core of his question, but also the processes, trying to make sure that servicers and states were thinking about the protocols for sharing information about a customer, as well as trying to get that customer into the loss mitigation solution and give them this additional funding to supplement or just to reinstate the loan entirely, to make sure that both parties really understood how that might work while they're designing the programs. And then the third was communications, which actually goes to the role question as well, that the extent to which everyone can be communicating about the programs, marketing them, promoting them, pointing consumers in the direction of the program administrators, how to apply, where to apply, what to do, encouraging them to do so. We wanted to make sure that the states and the servicers were thinking about it in the same way, so that we could try to not only sync up the programs, but drive customers to think about how to resolve their situation with all of these programs that are available to them.
Great. And then one final question, I think this one comes from Dana Dillard. Many of you know Dana. There are many changes happening in the industry. What is your approach to keeping up to date on all these changes, and what sources do you rely on?
That's a great question. And since from one Dana to another, I'll take this one for starters. We are and I now work in the industry. I work for a multifamily finance company, the #1 multifamily lender in the country. And I work on HUD multifamily, a lot of affordable. And I can tell you, it is a very rapidly evolving and competitive industry. That is a good thing. There are a lot of innovations. And I think technology is absolutely key. Having the data to keep up with these trends and, harnessing the power of technology, whatever we can do to, for example, to get, HUD continuing down the path of, becoming a little more technologically modern and putting in place the technology to be able to really be a part of the industry and to work well with the industry, especially, and I know they've done a lot in single family, but in multifamily, really streamlining the process, integrating data, working as an industry with things like NISMO. And, we're all going to be eventually, I believe, using blockchain. And how do we automate our processes? This is so important. And it improves the customer experience. It allows us to better serve the market. And in my case, to get units to market quicker. I think one of the things that we know and what we're seeing in the data when it comes to a crisis, sometimes the crises really point out the underlying problems. And we know there is still very much in this country a problem underlying with affordable housing. And so as Crystal talks about building the infrastructure so that we can support communities who need affordable housing, we do this through keeping up with innovations. We do this, we know that it is extremely important to do everything we can to get markets to get units to market. I think in HUD's case, there's a lot that HUD needs to do to streamline its process. There's a major backlog right now with what is called the HUD queue, the amount of time it takes an application to get an underwriter. But there are a lot of programs out there. Let's make sure that they work well and that they are, brought up to speed technologically in the best way possible.
Wonderful. Well, we are out of time. I think it's pretty clear that the federal efforts so far have been incredibly helpful, but we are in no ways out of the woods yet, and there's still a lot more work to be done. So I want to thank all of our panelists once again, and thank you all, our audience, for participating today. Thanks.